Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This is a chart of bond market volatility. Bond market volatility is absolutely going through the roof here, right? For the first time since 2020, March 2020 here, this was bond market volatility in 2020. This was bond market volatility in 2008. Both of these examples were major market crashes, and today is no exception. We have bond market volatility expanding as we see the stock market crash. Now, if we go back to the S&P 500, we can see the index is holding on to the 200-week moving average by a thread here. This is the last real secular bull run moving average that really held this entire run here. We're testing it as we speak, just like we tested it here in 2008, and just like we tested it and briefly broke through it in 2020. As bond market volatility, the MOVE index was spiking here. So let's talk about that because yes, bond market volatility is expanding, but it's definitely a very different situation to COVID in 2008. We have the bond market volatility spiking because of inflation, right? We have a lot of inflation, and so that's scaring treasury bond investors in the US. And same thing whilst in COVID and in 2008, this was actually deflationary, right? Deflationary scares, a collapse of the financial system, unemployment skyrocketing, same thing during COVID. And we can actually see this by looking at yield, that in these examples here in 2008, for example, you can see yields were crashing here. They were going down. During COVID, right there, you can see, again, big spike in bond market volatility, move down in yields. And this is very different to what we have today. Because what's happening today, we have bond market volatility expanding and we have bond yields rising, not falling, right? So that shows you that this is an inflationary scare for the first time since the inception of the MOVE index. We've never actually recorded this type of event on bond market volatility, that we're seeing this volatility because of inflation. So my question is this actually a moment to buy bonds while volatility is spiking, just like 2020 here and 2008? Ideal moments to sell bonds. And I can show you what I mean here. If I add TLT, Treasury Bond ETF, you can see this spike right there, this spike in bond market volatility corresponded with this peak in TLT, the Treasury Bond ETF. That was about as good as it gets when it comes to timing the actual top, when it came to actually selling your bonds. And same thing here in COVID. Guess where volatility spiked? Right there, right here, which was probably one of the most attractive opportunities to sell your treasury bonds. So now that we're seeing the exact opposite thing happen with spiking volatility while the bond market is completely crashing, right? This is absolutely insane in terms of the size of this move. Is this the moment to be buying bonds? So that's exactly what we're going to take a look at right here. And we're going to do that by looking at the yield curve. And by the way, there's only a day left before the new website is live. A day to go, and also a day left for you to get a discount, a 20% discount on the membership. We don't do these kinds of discounts very often because the price of the membership is already very cheap. But for the 2-year anniversary and the launch of the website, we are doing a discount for the last people who sign up to the old website. So make sure to not miss this chance. Okay, so back to the video. This is the 10-2-year Treasury yield curve. It's a predictor. It's a recessionary signal for a lot of different reasons that I'm not going to talk about right now. But it's been incredibly accurate, at least for the past 30 years right here, at predicting recessions. 89 recession, 2000 recession, 2008 recession, 2020 recession, 2022 recession. Now, why am I talking about the yield curve here? Why am I talking about a recession? Because George Soros, the famous investor in The Alchemy of Finance, said the best time to buy bonds is when the yield curve is inverted. Here, not only is the yield curve inverted, but we've seen one of the largest drawdown, peak to trough, in 10-year treasury bonds ever, right? And that includes the 1960s, the 1970s, the 1980s. Just think about that for 1 second. This is the worst drawdown ever. And the yield curve is inverted, which is an early signal of a recession. And what happens during a recession? Bonds go up because investors are looking for safety. They look for safety in an economy that's slowing down. And this is exactly why, despite the fact that this is clearly a complete collapse of the bond market, right? This is TLT. We've never seen anything like this, right? This is absolutely ridiculous. The wealth destruction that this is completely ridiculous. We have never seen anything like this with the bond market, which is the biggest market in the world. So despite the panic that we're seeing here, we are hedging our model portfolio that does have a lot of equities right now because we think it's a good time to be in stocks. We're hedging with treasury bonds. Now, the model portfolio is a feature on our website that we update multiple times a quarter. And right now, as I said, we're currently looking to have a portion of the portfolio in treasury bonds because our opinion is that the economy is going to slow down. And yes, we're optimistic on stocks, but a big risk to the bullish stock market thesis is that we have a collapse in earnings, that a financial crisis occurs more quickly than perhaps we initially anticipated. And we need protection against that. We need protection against the idea that we might be wrong on a recession actually taking a while before it materializes, which is our current view on the market. So to summarize, this is definitely scary. Right here, treasury bonds collapsing like we've never seen before. Perhaps this is a unique opportunity where we're seeing a capitulation event right before a period of time that could be the most important moment in history to have treasury bonds, right? Think about that for a second. The Fed is tightening like never before. Recession probabilities are rising. You are gradually going to enter a period of time where investors are going to seek protection from treasury bonds. Now, I don't know how far this is going to go, and that's perhaps very dangerous here, that clearly treasury bonds are covering a lot of ground very quickly. But in any case, we'll keep you updated every step of the way. Now, if you enjoyed this episode, don't forget to smash that like button. It really helps push out our videos to more people. It makes the effort and the time that we put into making these videos, it really does make it worthwhile. So it is very much appreciated. And also subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.